Good afternoon, everyone, and thanks for joining us. I'd like to welcome you to this Monday Minute Chat hosted by the Canadian Leadership Congress. Now, our topic today is fixed income, and specifically whether or not we're facing a secular bear market in bonds, and if so, when. And to talk about it all, I'm here with David Stonehouse, Senior Vice President at AGF Investments, and Rainer Kaufmann, Senior Director, Fixed Income, Funding and Liquidity, Capital Markets Group, OPTrust. Welcome, David and Rainer.
Thank you very much.
Good morning, Caroline. Thanks for having me.
Yeah, looking forward to this discussion. And let me start off with the title of this session, a little dramatic, I will admit, but let's get on the same page here. Do we think there's a bond bear market on its way?
Well, from my perspective, I think we need to distinguish, first of all, between a cyclical bond bear market and a secular one. And it's quite apparent to us that we're in a cyclical bond bear market. Yields have backed up pretty substantially over the last year. Total returns have been moderately negative over that over the last 6-9 months, mid-single digits. So quite clearly, that's a bear market for bonds. And fairly significant one at that, because most bond bear markets, you see returns, 0, +1, -2 or 3, that sort of thing. The bigger question that you're posing is whether or not I think we're staring at a secular bond bear market. And from our perspective, we think that it's potentially a little bit early for that to be the case for a number of reasons. But there are some ingredients that are gradually being put into place for that to potentially transpire down the road. Perhaps the couple of examples I would cite that are most prominent are, first, the Fed's monetary policy has taken a noteworthy shift over the last year. Their new flexible average inflation targeting approach is a real contrast to what we saw a few decades ago. So in the end of the 70s, the early 1980s, Paul Volcker, who was Fed chair at the time, basically ignored unemployment in favor of slaying the inflation dragon. And now you've got a Fed that's almost gone to the opposite extreme, where it's focusing on full employment almost at the expense of inflation. So I think that's one necessary ingredient as a precursor for a secular bear. Another one is the fact that yields have gone negative in much of the world. So we're starting to put some of the ingredients in place, but in our view, it's a little bit early to be pondering the incipience of a secular bear.
Interesting. Rainer, what signs are you watching for?
I look at all those macroeconomic that David just spoke to, but just diving down to a lower level, I'm really look at the real yields on the U.S. 10-years, and those have gotten down to negative 1.1% at one point in time, and that's pretty low. Any past history of real yields shows it's rare to be in negative territory for very long. And the more usual level for the US 10-years, more like 0.5% in the last 5-6 years. So I expect us to revert to that, and that's going to drive up yields in the nominal space when it does that.
Interesting. Well, look, both the Bank of Canada and the Fed have recently reinforced their assertion that no stimulus will be withdrawn until an inflation target of just over 2% is reached. What's your reaction to that?
Well, from my perspective, the two central banks are following, in my view, fairly distinct approaches versus perhaps being more in sync in the past, in that the Fed has explicitly said repeatedly, and they've been adamant about this, that they want to get to full employment before they contemplate tightening policy significantly. They've started to hint at the possibility of reducing the volume of quantitative easing that they've been undertaking over the last while. But rate hikes look to them to be still very far off. And it's noteworthy that their most recent economic projection anticipates full employment of around 4% unemployment by the end of 2022. And yet they still, on balance, are not anticipating hiking rates for at least a year later. You contrast that with the Bank of Canada, and their most recent economic projections suggest that inflation is going to overshoot their 2% target by a modest amount for each of, or most of the next 3 years, 2.3, 1.9, and 2.3. And they've brought forward expectations of when they'll start to hike to the second half of next year. So they are following the more traditional approach of anticipating and trying to get out ahead of the potential for inflation spiraling upward, whereas the Fed has consciously adopted a different strategy than their traditional approach.
Yeah, and that's left some uncertainty out there for investors, hasn't it, Reiner? What are your thoughts on that?
Yeah, there's definitely uncertainty out there. I think the great uncertainty is the role of the fiscal policy by the various governments. There's a great desire. We have a K-shaped recovery where many people are doing quite well through the COVID period, but there is a structural unemployment which is lagging, which policy makers want to address, because they don't want people to be unemployed for continual periods for a large part of that population. Therefore, there's going to be a continued fiscal ease, and with real rates as low as they are, there's little damage to running a deficit and issuing bonds by the governments to fund that. So that's a policy they're going to take, and that's going to result in potentially lower short-term rates for a longer period of time as the markets, as we claw our way out of this K-shaped recovery.
Huh. And is that K-shaped recovery, David, is that impacting your thinking right now?
Yeah, absolutely. I think just to follow on Reiner's comments, I agree with his perspective on that, and would add that the central banks, especially the Fed south of the border, but also we heard it in recent remarks from Tiff Macklem, the governor of the Bank of Canada, are really focusing on the underprivileged. They're really focusing on driving towards full employment. Fed speakers in recent months have repeatedly come out and stated that mantra. And it's quite clear that despite the fact that there are signs of potentially some excesses in portions of the capital markets and very strong activity in certain areas, nevertheless, you're still seeing unemployment levels that are higher than both central banks are comfortable with, and certainly wage levels that they've been frustrated by. And so they're consciously targeting the one aspect of the K that you're alluding to, the lower branch, and basically eschewing concerns around the overheating of the upper branch for the time being, at least.
Huh. Now,
yeah, I think to that point,
yeah.
I think the past history has shown that the central banks do not fear inflation. They get 2%. They have no fear that they can manage that. But what's interesting there was, we've come over a 30-year period where Paul Volcker sent a strong signal and changed people's expectations for what inflation would do, and that caused rates to drop. And then in the late mid-90s, there was all a question of deficit spending and on the fiscal side, and governments with dropping inflation but continued high rates found a penalty to run a deficit spending. Therefore, they stopped that. But now we still have a signaling where we're okay with inflation and we're okay with deficit spending, and that's sort of a mixture which could lead to higher inflation going forward.
Yeah, I think coming back to the initial question that you posed us, Caroline, I think that's the critical issue down the road is at what point, after having won the war over inflation, which took several decades, do the authorities relax their guard too much, place too much faith in their ability to control this? And much like Pandora's box, if you let if you open the box and I'm mixing metaphors, let the genie out of the bottle, then the question is, at what point do you actually start to get more runaway inflation? And back to that initial comment, we still don't believe that we're at that point yet, but the risks are starting to rise.
That's a really good point. Before our conversation, I was talking to a couple of our Canadian Leadership Congress advisory board members about their views on fixed income, and inflation really popped up as something that they have a very close eye on. I'm sure you can relate to that, Reiner. Can you walk me through what higher inflation is going to mean from your standpoint?
Well, so we pay pensions for our union members, and it's a large part of their expectations of future income for their retirement years, and we need to be there and have that. So inflation is a drag on their potential future income. It's almost a tax. We have some inflation hedging in our portfolio and indexing for our members if we manage to outperform. So we're very conscious of where inflation is going and how that might impact what we have, what resources we need to, and what we have to pay. Having said that, we do have return-seeking assets, and those assets, largely in equity, real estate, etc., do have some correlation, if you will, to higher inflation. So if higher inflation is met with, as a result of better growth in the economy, richer times, then that's all good. It's more of a stagflation scenario, which is the real hurtful experience for us, where there is no growth in asset prices, and yet there is still inflation. And that's what we really worry about.
Good point. David, we haven't talked so much about interest rates yet. This is another factor that's on the horizon, potentially rising interest rates. Talk to me about how that inflation, some of the things we're talking about, affects your decision making as a fixed income manager.
Yeah, we've been anticipating a rise in inflation. I don't think it was an outlandish thing to conclude over the past year. It was pretty apparent that we were going to get more inflation this year. Just anniversarying the worst quarter in economic history for North America in the second year means that you're going to stumble over easy year-over-year comparables. And when you see something amazing like a negative oil futures last April, that's about as deflationary as it gets. And the year-over-year comparatives are effortlessly going to result in higher inflation, and that's what we're seeing right now. So the big debate has been around how transitory the rise in inflation that we've been seeing recently is, and we're seeing some prints there that are, depending on the metrics you're looking at, whether it's economic surveys or inflation, that are anywhere from decade highs to multi-decade highs. So some of this is coming home to roost. The question is how transitory it is, and that's been the $64,000 question that everybody's been focusing on. Some of it is due to base effects year over year, as I outlined. Some of it is more pervasive in that we've had some real supply disruptions because I don't think most businesses or individuals, for that matter, anticipated the rapidity of the rebound that we've gotten from all the stimulus that was put in place last year. And I think that caught a lot of folks by surprise. And those supply bottlenecks, which have been exacerbated by some of the trade issues that have arisen in recent years, have really resulted in a more pervasive flow-through impact in terms of inflation. You've also got the potential for more wage inflation as trying to match skills to job openings has been a real challenge. Getting people back in the workforce where working mothers still have to deal with children being homeschooled. Starting to see wage hikes from a bunch of major corporations and authorities talking about hikes to minimum wages. That's where the rubber's going to meet the road over the next year. So for sure, inflation is going to be hot this year. Whether or not it's transitory, I think in a lot of respects is going to come down to expectations around wage growth on the part of participants in the economy. And that's where it gets more interesting. We've already had a bond bear market, a rise in interest rates that's lasted over a year. We don't think that it's over yet, but you've seen a strong rebound in inflation rates already. And the break-even inflation metrics are already back to decade highs. Where we haven't seen a rise in interest rates is the part that Reiner alluded to before, which is real yields, which are still pretty close to rock bottom levels. And that's what we'd be focusing on next.
Reiner, how is all this affecting your decision-making right now? Some easier decisions, some more difficult decisions?
Yeah, well, we look at our portfolio at the fund across all asset classes, and we make a mix. And yeah, it's no secret, given the annual reports of the various pension plans out there, that a few pension plans lightened up on their fixed income coming into the end of 2020 and into 2021. And I think that just reflects the expectations that real yields were very, very low and likely to rise. However, even though they were low and fixed income was likely to be a losing proposition, there's always a spot for fixed income assets to balance out the risk of your portfolio. So we maintained a position in that. Going forward, we would love rates to rise. It would be painful. It'd be a slow ripping of the Band-Aid off. Over the next 2 years, I think we'll see as real rates go back towards zero in the US 10s and rates rise by another 80, 100 basis points. That will be painful, but it doesn't mean you don't want to have some fixed income exposure.
Yeah, and I would maybe just add to that we have owned inflation-linked bonds over the past year. We've been starting to trim them just a little, just because they've had such a good run already, and they're, as mentioned before, at decade highs in terms of the break-even rates. I think that the year-over-year comparisons, while they're still going to be robust for 2021, are going to start to be more challenged as we progress through the balance of the year and into 2022. So we've started to lighten up on those a little bit. We've done well by them, and I think that their opportunity relative to nominal bonds is starting to diminish going forward, even though we've still got some pretty hot inflation data. We're still short duration. We would agree with Reiner that interest rates rising further would be welcome, albeit painful. That allows you to reset with higher coupons and better income generation. And the journey is not the most pleasant, but the destination will be a better place. So we would certainly be looking for another leg higher in yields over the coming few quarters.
So, we're talking about a K-shaped recovery and looking more broadly across the fixed income spectrum. Corporate high yield bonds, how are you viewing those right now, given some of the major economic bumps we've hit over the last, say, 18 months, David?
On the corporate side, this has been a very different recovery than what ensued following the global financial crisis. That was, frankly, a slow-moving train wreck on the downside that unfolded over a couple of years and then took several years to gradually recover. And it presented an outstanding opportunity for credit investors because you had several years of outsized gains in high-yield bonds and very attractive returns from investment-grade bonds, as spreads gradually tightened, reflecting the gradual improvement in the underlying economy and the credit quality of those issuers. This time around, this has been a very compressed cycle. It all hit all of a sudden. We had the worst quarter in history in the second quarter last year, economically speaking. And we had an enormous rebound and snapback very quickly in the credit markets because the central banks explicitly went into the markets and backstopped credit and also backstopped economic activity to a fair extent, to the extent that they could. So spreads have tightened in far more quickly than they did last cycle. And unfortunately, that means that the prospects going forward are more limited. We still think that credit is, on balance, a better place to be than underlying sovereigns because they're a little bit less affected by a rise in interest rates, but they don't present the same multi-year alpha generation or outperformance potential that they did coming out of the global financial crisis. So on balance, we'd still prefer to be there. We just expect pretty muted returns from this point forward as compared to the last cycle.
Reiner?
Yeah, I agree that spreads, high yield spreads, which March, not last March, a year ago March, were up to 1,000, are now down to 300. A massive move. There's no juice left in there. But having said that, the economy is so well supported by the fiscal arrangements that the risk has diminished remarkably in those assets. And so, if you're picking up 300-400 basis points over sovereigns, and you can invest for 4 or 5 years in that, you're not likely to suffer losses as yields rise up because your duration is short And in fact, you're going to have nice carry. So it is a, in your total portfolio, they certainly have a spot to give reasonable yields with reasonable risk without having a significant interest rate exposure to the market.
So there's a lot of shifting variables right now in the policy landscape and the economic landscape. As all this shakes out, whether it's interest rates, inflation, what's the best case scenario right now for pension investors, and how likely are we to get there, David?
I think a gentle glide path is always preferred. So if you get sharp disruptions in the capital markets, that tends to be more painful. And those dislocations we saw evidence of in the first quarter in February and March. Those can be a little gut-wrenching for broad swaths of the capital markets, not just sovereign bonds, but it can spill over into equities and elsewhere. If you have a more benign rise in yields over time, that's something that the markets can assimilate and can manage through without as big a hiccup. So your best case scenario is that we gradually work our way higher, get better reinvestment rates, coupons improve, and yet you don't get a short, sharp shock that really puts a dent in your portfolio and causes some damage on the bond side and potentially on the equity side. So, we're talking. The line of demarcation might be along the lines of, say, 0.5% in a month sort of thing on US 10 years. If you move up at a pace that's more subdued than that, you can probably weather it. If you see a very sharp uptick in bond yields in a short period of time, more than 0.5% in short order, that's where you start to see spillover effects into other portions of the capital market. So that's your best case scenario, is you just continue to rise gradually.
How hopeful are you that that's going to be our scenario?
Well, we saw some pretty historic numbers back in February, March, as mentioned. When you take a look at the rate of change, when you take a look at the basis points of move, you were looking at a top 3 or 4 scenario. And when you take a look at the price loss, the capital loss associated with the rise in interest rates, you were looking at a top 3 or 4 scenario going back over the last 3 or 4 decades. That's pretty significant, and usually it takes a while to digest that. Markets don't go up or down in a straight line, and that's what we've seen over the last couple of months, is a good period of consolidation. I think Reiner mentioned earlier that he still anticipates that yields have got some room to rise in the coming year or more. That, I think, is still true. I think there's another leg higher once we get through this consolidation period, and maybe we're already embarking on a little bit of a move higher. So I think that another leg is in front of us. It probably won't be as sharp as the first one. I think everybody's attuned to this inflation story. It's not a surprise to anybody. It's just going to be how persistent it is and how intense. So I don't think it'll be as strong as the impact we saw in February and March, but I think there's still more to come.
Reiner?
Well, I think it's interesting when you look at the difference between the short-term expectations. The expectations for the short term of the market and the longer term, because Eurodollar futures, BA futures, money market futures in general, they're only building in 2 to 3 rate rises over the next 2 to 3 years. It's rather sanguine, and that's probably where the market ends up. But the long end had to sell off and had a bit of a knee-jerk reaction because they're getting different signaling from the governments and from the Fed, whether rates are going to rise or not, and there's a fear of inflation. I think once we get past that the chances of a big knee-jerk reaction in the long end of the curve diminish. But on the other hand, I think we do have to, in the next 2 to 3 years, we will see rates rise, maybe 100 basis points sort of thing, and US 10s tips go back to a 0 to 0.5% rate. In which case, yeah, we're going to see a gradual sell-off within the bounds that David would find acceptable of 50 basis points, over a month or a quarter.
All right, we spent a lot of time. Oh, go ahead.
Sorry, Caroline. I would just add that the more the Fed keeps the short end at 0, the more room they allow for the long end to rise, because the more they're allowing inflation to continue to percolate, the more they're allowing this economic rebound and real activity to continue to blossom. And that should be reflected in a steeper yield curve. And we saw a significant move in the first quarter in that direction. I think there's still room for more. So that's going to be the interesting part of this. Ironically, when the Fed actually starts to hike, which in our view will be before 2024, and they'll be happy to lose out on that bet, as it were. I think for them, being dragged into an earlier rate hike would be a declaration of victory, because it means they accomplish their objectives of full employment, but they don't want to jump the gun by saying they're going to get there too soon and curtail the goal of reaching full employment. But ironically, when we start to see rate hikes down the road, that's when bond yields will probably stop rising as significantly. And one final point I would mention, just on the inflation score again, it's interesting that long-dated inflation expectations remain lower than short-dated inflation expectations. So this is still a market that believes that we are not moving into this 1960s into 1970s world yet. They still think that, they recognize this is a cyclical episode, but there's still skepticism out there as to whether or not this is going to be pervasive over the long term.
All right, good point. Well, look, we've talked about a lot of challenges in the market and some unknowns, but what's the opportunity right now? David?
I think let's look at different scenarios. So one opportunity that was being heavily discounted last year is the benefit of bonds in a poor capital market environment. There's been a lot of chatter around the demise of the 60-40 portfolio, the 60-40 mix, or whatever mix you might want to employ to try and balance reasonable returns over the long term with acceptable risk levels. And with yields at 50 basis points last year, you just don't get a lot of downside protection from bonds anymore. They just don't have a lot of room to rally more in the case of a problem, let's say on the equity side. Now you're already at the better part of 1 3/4 on 10-year yields, and the potential for a little bit more. That's starting to build in a bit of a cushion again. So if we had an episode where we saw stocks correct 10% or more, now you'll probably see bonds move up a little bit in price and yields come back down, and you can make 3 or 4 or 5% in bonds to offset that kind of a decline. I think the flip side is thinking about more optimistic scenarios for the future, and therefore more challenging scenarios in terms of an ongoing rise in interest rates. And one area that we've favored is convertible bonds, because they do allow you to capture some more of the upside if the underlying equity of an issuer continues to rise substantially. Your converts can actually make more than 100 cents on the dollar in the coupon, which is what typically you get from investing in bonds. And that to us has been an intriguing opportunity that's done really well over the last year, and we still think has attracted medium-term prospects relative to regular bonds.
Great. Reiner?
Yeah, to continue on with those thoughts, I think that the hedging potential of bonds, is the correlation of bonds and equities typically has been negative. When you get into an inflationary environment, suddenly the correlation becomes positive, which means when equities sell off, so do your bonds. And that's what we've entered into that in 2021. The correlation did flip, and that's a bad, makes bonds, longer term duration bonds, not a good hedge for their equities, which is unfortunate, because we rely on that a lot. Most pension plans do. So what's good going forward is probably alternative investments, some commodities. I think short-term, medium-term credit, high yield credit is a good alternative, but it still leaves you open to a hedge and wanting to find a hedge for your equity positions when markets go down. And that's why you in spite of the fact that there's limited potential for long-term bonds to appreciate in a rising environment, they will, if there is an economic downturn of some strength, and that will provide a bit of a hedge for that to your total portfolio.
I think it's a good point that Reiner raised on the correlation between bonds and stocks. So Since the end of the 1990s, there's been a very beneficial environment where the two have had somewhat of an inverse correlation and naturally offset each other. That does look like it's flipped in the short term, but we still view over the long term a line of demarcation between an inverse correlation and a positive correlation being somewhat higher than here in terms of 10-year yields, most likely, getting closer to a 4% level. And the reason for that is, generally speaking, when things are getting better, bond yields should be rising and stocks should be doing well. And you're getting closer to the escape velocity term that was being discussed a lot over the past decade. And the markets tend to like that. And conversely, if it looks like we're going into a recession or deflationary environment or even depression type scenario, that's where stocks don't like that environment, but that's pretty welcome territory for bonds. So we still think that inverse correlation over the long term is going to remain intact until we start to get back to the sort of normal interest rate levels that we saw in the 80s, 90s, which in our view is still quite a few years off. One other thing I would add is that another area that we would favor is private credit, but you have to be doing your homework there. You got to be very selective. You don't have the same degree of liquidity as you do in the public markets. And so I think if you're very judicious in that area, you can add some value, but you've got to have some good expertise in your corner to help out in that regard.
Excellent. Well, look, that wraps my questions for the day. I'd like to thank both of you, David and Reiner, for joining us and for your excellent comments. I certainly learned a lot today. And I'd like to thank all of you who are joining us for today's Monday Minute. Don't forget to send us your questions and we'll get right back to you with a response from today's panelists. And again, thank you all for joining us and see you next time.
Thanks, Caroline.
Thank you.